Hi, this is Kirubakaran Rajendran. Welcome to Trading with Groww channel. If you are confused about what indicator to be used, because there are so many indicators that are there in the current trading environment. So out of that, what are the best indicators which I can choose and trade? So if you are having this confusion, definitely this video is going to be really helpful for you because I'm going to talk about top 5 indicators which you can use in your trading. So the first and foremost one will be a moving average indicator. See, with respect to moving average, what most people does is say they simply follow a traditional approach, which is they wanted to follow, say, suppose 200-day moving average is there. They'll just use a daily chart and plot a 200-day moving average, and then they see if the market is bullish or bearish. See, as long as the market is trending like this, mostly it will be on either on the above or on the below of moving average, which means either it will be bullish or bearish. But when market trades sideways, it goes in a zigzag mode like this in this zone. If you see, there are many days where it went above moving average and went below moving average, again went above 200-day moving average, went below 200-day moving average. So when markets are sideways like this, if you apply a moving average, it might not give you a clear picture. So what moving average really helps you is identify the long-term trend. So if you are using moving average, always use it on the long-term chart. So instead of using a 200-day moving average on a daily chart, even though it would help you to capture this big trend, but it would give you a big whipsaws when markets are in sideways. So how do you avoid that? So the only way is moving from daily moving average to a monthly moving average. So what you can do is change the time frame from daily to monthly. Now, the moving average, you have to change it from 200-day moving average to 10 moving average. What it does is it plots a 10-month moving average. So you are totally avoiding a daily noise and moving to a monthly time frame gives you a clear-cut trend. So now this 200-day moving average is directly equal to 10-month moving average. Both are more or less covers the same period. So now if you plot it in a chart, on a monthly chart, and then if you see, it would be easily able to cover the bigger trends where the daily whipsaws are avoided, and only if the monthly chart goes below the 10-month moving average, we are going to sell it. And if it closes above 10-month moving average, we are going to buy it. For an example, if you observe this corona crash period, so this period, if you see on Feb, this specific indicator has closed below the monthly moving average levels, which is the 10-month moving average. Then you are able to exit at the right moment. The February itself, you would have exited your long position, and this whole month of March crash, you would have been escaped from it. And similarly, by October 2020, when the Bank Nifty was closing above the 10-month moving average, you would have entered in it, and you would have been able to enter at around 23,000 and all the way until this level where it closed below 10-month moving average, which is 35,000 level. So almost 15,000 points you will be able to capture in Bank Nifty by moving from daily time frame to a monthly time frame and applying a 200-day moving average versus 10-month moving average, where the 200-day covers the daily noise, where the 10-month moving average would be able to avoid those noise and capture a bigger trending moves. So that is why it is better to apply moving average indicators only to predict the long-term trend and play a long-term game. So avoid moving average on a shorter time period, instead apply in a longer time period to capture a bigger trend. And the next one I'm going to talk about is ATR. So when I say ATR, most of the people what they type is the ATR average true range, which by default comes in an indicator. So if they apply it, that is going to plot what is the average true range one can expect in an absolute terms. Say currently if the ATR is showing a 637 points, which means this is the ATR levels on a daily time frame of Bank Nifty chart. So as per this indicator, when you whatever the value you see, that is the expected value of the movement in Bank Nifty in the coming days. So on a daily time frame, say currently Bank Nifty is closed at 47,835 and ATR level is around 640, which means that Bank Nifty can either go up 640 points or go down 640 points in the next day. So that is the expected range based on the ATR. So what happens is this will give you the movement in absolute terms. So when you wanted to back test, it will always show in absolute terms only. So earlier it was around 500 levels, and now it is around 630 levels, which means that the current ATR level could be higher than the previous ATR levels. So you might think the ATR has increased, but that is only in the absolute terms. So always check ATR in percentage terms. So go to indicator and type ATR and type percent. Now we will have a percent here. So if you see ATR percent, so this is a indicator which you need to apply. If you apply this, then from absolute it gets changed to percentage terms. So earlier, this absolute terms shows 500 was the ATR level, which we thought was lowest, and in ATR percentage terms, which it is around 1.2%. So now the ATR level, if you see, it is around 640. So compared to the previous 500 levels, this ATR is actually higher. That is what the typical average ATR will show. But in percentage terms, if you see, it is around 1.32%. So always check the ATR percentage in terms of percentage versus absolute. The absolute might not give you the right picture, but the percentage will give you always the right picture. So whenever you wanted to see what would be the expected range of Bank Nifty or whatever index for the next couple of days, instead of checking the absolute terms, always check the percentage terms. So simply based on this, how you can trade is, say currently Bank Nifty's level is 47,835 and percentage is 1.32%. So this is the expected range on the upside or on the downside. So what you can do is, you can do a short strangle on a positional trade where 1.32% is the expected range, right, which is around 630 points. So what you can do is short 800 points or 1000 points away call option and 1000 points away put option. That is the short strangle position which you can take, because the expected range is only 600, so it would not breach your 1000 points of overall range on either side. So this way your option premium will decay and it can end up giving a good reasonable profits. So if you do, instead of choosing a short strangle on a fixed percentage like 500 points away, 600 points away on a simple terms, check the ATR levels and see where the ATR levels are there. If 600 levels is the ATR, then you can just use 1.5 levels or 1.8 levels from this level, which can give you 800 or 1000 points away strike. So choose 1000 points away strike on either side and short it. This way, it is not going to breach on both the sides and option premium will decay and you end up making a good profits. So this is how you can use ATR and trade with respect to options. And the next one is the widely used super trend indicator. So this is one of the best trend identifier indicator where you can ride the trend and also you can trial the overall profits much easier. So all you have to do is just check these green bars and red bars. So whenever the green signal comes, it means that the buy signal is initiated. You just go long. And the best part with respect to super trend is it works in any time frame. You can be it in 30 minutes time frame, daily time frame, or even if you are an intraday trader, you can apply a 5 minutes time frame and it would help you to capture the big trending moves. So you don't need to worry about choosing the right time frame. So in a smaller time frame, obviously there will be these kind of zigzags. On a larger time frame, it helps you to capture a bigger trend. Like for an example, if I apply a 30 minutes time frame and by March 1st it gave a buy signal, and till date that buy signal is still valid. So around 46,000 levels it would have given a buy signal, and currently Bank Nifty is around 48,000 levels. So you would have easily able to trend the capture. You would be easily able to capture that 2000 points trend in just one single trade by moving to a 30 minutes time frame and applying a super trend indicator. So super trend indicator, if you're planning to use it, you can use it on a daily time frame, 30 minutes time frame, or 5 minutes time frame. It is totally up to that kind of trades which you take. If you're a swing trader, then 30 minutes time frame is a recommended one. If you're an intraday trader, then 5 minutes is the recommended one. Since we have seen the trend following indicator of super trend, let's check a mean reversion indicator, which is RSI, relative strength index. So just like how super trend helps you to capture the complete trend, RSI helps you to identify those reversal zones. So whenever the market gets into a oversold zone like here, where it went below this RSI 30 levels and then started reversing from there. So that would help you to capture the exact bottom of any kind of instruments. So with respect to Nifty 50, the moment it goes below 30, you are not going to buy it immediately. You have to wait until it comes above 30 and you are just buying it right here. Similarly, whenever it goes into a overbought zone, whenever it goes above no RSI 70 zone, you just wait until it goes below that specific zone levels. So once it gets into a overbought zone and then it gets in comes down, then that is when you can short it and then capture the whole downtrend moves. So basically RSI helps you to identify these tops and bottoms, which will greatly help you to identify a mean reversion trade. So instead of, if you're a trend following indicator, if you're just a trend following person, follow a super trend kind of an indicator. If you're a mean reversion person, then it is better to identify these kind of reversal methods using RSI. So with RSI, all you have to do is identify these zones, just like I said, where once it gets into a overbought zone, wait for it to come down, go up above RSI 70 and comes down below RSI 70, so that you can easily capture that reversal zones. Like as I said earlier, market went up here and RSI also went down here, so you can easily short the markets here. And exactly when market starts reversing, it goes below 30 and then crosses above 30 from bottom. So that is when you would be able to go long in the markets, where you can easily identify those bottom levels. So you can go short here and then you can go long here, and either you can just buy a put option here or you can buy a call option here. So either way, you would be easily able to identify those reversal zones using RSI indicator. And the final one is the downtrend indicator. So you just go and open any stocks and type downtrend channels. That is going to help you to identify those breakout zones. So it is a 20 days downtrend channel indicator which keeps tracking the last 20 days high and the last 20 days low. So whenever the market goes above the last 20 days high, you can just enter into the markets and keep trailing the last 20 days low. When the moment it goes below last 20 days low, you can just close your position. But this is greatly going to help you in identifying a very big trending market movements. Like for an example, Tata Motors, if you see, so during this 21st March 2023, it was in the lower level, which is downtrend indicators. The last 20 days low was broken, so you would have gone short here. And the moment it goes up and then crosses above the last 20 days high levels, it would have given you a buy signal, where around 453 it would have given you buy signal, and you would be able to ride the trend all the way till around 1000 levels now. So your overall capital will be more than doubled, and still the last 20 days low was never broken. It was still on a upper trend zone. So this you can change into a last 20 days to whatever levels you want. Instead of 20, you can change it to 40 and apply it. Then it would keep tracking the last 40 days low. So if you are a person who is a swing trader and trying to capture a bigger trending move, it is wise to change from 20 to 40, so that these kind of bigger moves you will be easily able to capture. For an example, from 29th March, the same moment, after it gave you a buy signal, once it moves up around 450 levels, and it never touched this bottom blue line. However, if you use a downtrend indicator of a lower time zones, like instead of last 40 days high and low, if I wanted to use last 10 days high and low, then definitely the overall range becomes much narrower, and it can give you multiple buy and sell signals. So if you wanted to hold it for a longer period of time, at least for a few weeks to few months, always use a downtrend channel with a higher time period, which is 30 to 40 days. That helps you to capture a bigger move. So downtrend channel is good for people who are positional traders. You can use it for stock futures, you can use it for index futures, but use it for a higher time frame period like 30 days or 40 days, so that you could capture the complete big trending move. If you use a lower time frames like 10 days or 15 days, you can still capture it, but there could be a lot of buy and sell signals that can keep coming up. So downtrend channel just tells you a breakout levels of last 20 days high and last 20 days low. As long as it trades above this specific higher zone, it is a buy signal. The moment it touches the last 20 days low, you just have to exit it. And this 20 days high and low, you can totally customize it based on your requirement and your risk appetite. Higher the time frame, much better the returns are going to be. So you can just click here the settings and change the length to whatever the levels you wish. So the ideal level is 40 and the default level is 20. So these are the top 5 indicators which you can apply to your existing trading methodology. I hope you found this video really helpful. I'll see you guys next week with another video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.